After studying this module, you shall be able to know the meaning of working capital, understand the need of working capital estimation, learn various techniques of estimating working capital needs, evaluate the various policies, and choose the optimal level of inventory. The smooth functioning of business depends to some extent on the efficient management of working capital and for proper management of working capital. And it is important to estimate the working capital requirement. A firm must estimate in advance the requirement of working capital. Once the working capital is estimated, it has to be further divided into permanent working capital and temporary working capital. The permanent working capital is financed through long-term sources and temporary is financed through short-term sources generally. But it is not fixed. It depends upon the management attitude and approach. In conservatism approach, some part of temporary working capital is also financed through long-term sources. Methods of estimating working capital requirement. There are different methods available to estimate the working capital requirement. 1. As a percentage of net sales. One way of estimating the working capital requirement is as percentage of net sales. It is assumed that the working capital is directly related to sales. In estimating the working capital as a percentage of sales, first step would be to calculate the current assets as a percentage of net sales. Then current liabilities are estimated as a percentage of net sales. The difference of the two will give working capital as a percentage of net sales. How much current assets or current liabilities should be maintained at a given level of sales? This has to be assumed by the firm on the basis of past experience or on the basis of similar firms in the same environment. First line shows year, net sales, current assets, current liabilities. The first year, net sales are 10 lakhs, current assets are 2 lakhs, and current liabilities are 70 lakhs. In the year 2, net sales are 12 lakhs, current assets 2,45,000, current liabilities are 80,000. Now let's look at year 1. Current assets as percentage of net sales is equal to 2 lakhs divided by 10 lakhs into 100 is equal to 20%. Current liabilities as a percentage of net sales is equal to 70,000 divided by 10 lakhs into 100 is equal to 7%. So working capital as a percentage of net sales is current assets minus current liabilities, which is equal to 20% minus 7% is equal to 13%. In the year 2, you will observe current assets as a percentage of net sales is equal to 2,45,000 divided by 12 lakhs into 100 is equal to 20.416%. Current liabilities as a percentage of net sales is equal to 80,000 divided by 12 lakhs into 100 is equal to 6.66%. So working capital as a percentage of net sales in second year is equal to 20.416 minus 6.6 is equal to 13.75%. Now let's estimate working capital. Average current assets as a percentage of sales. This is equal to the average of first and second year, which is equal to 20 plus 20.416 divided by 2, which is equal to 20.208%. Similarly, average current liabilities as a percentage of sales is equal to average of 2 years, that is 7% plus 6.6 divided by 2 is equal to 6.83%. Now estimating working capital as a percentage of net sales is equal to 20.210 minus 6.83 is equal to 13.38%. Let's say if next year the sales is expected to increase by 20%. So the increase in sales is equal to 12 lakhs into 20% is equal to 2,40,000. So new sales will be equal to 14,40,000. So net working capital is equal to 13.38% of 14,40,000. This is equal to 1,92,672. Gross working capital, which is sum of current assets, would be 20.21% of 14,40,000, which is equal to 2,91,832. Out of which, if 6.83% of 14,40,000, that is 98,352, will be financed through current liabilities, then in estimating working capital requirement, if there is a consistent trend, then consistent increase in current assets, current liabilities and sales, we may use weighted average instead of simple average. The second method of estimating working capital as a percentage of total sales or fixed assets. Total assets of the firm comprises of fixed assets and current assets. For example, if the total assets of the firm are 80 lakhs and current assets are 20% of 80 lakhs, that is 16 lakhs, this would be estimated gross working capital. If current assets are 20% of the total assets, it means that fixed assets are 80% of total assets. So the relationship of current assets with fixed assets can be established. In this case, current assets would be 25% of fixed assets, that is 20 upon 80 into 100. Similar relationship can be established between net working capital to total assets or fixed assets. Number 3, working capital on the basis of operating cycle. In this approach, the working capital depends upon the operating cycle of the firm. The operating cycle for different components of the working capital gives us time for which assets is maintained once it is required. In this approach, we study each component of the working capital and estimate the time each component is required to be maintained by the firm, and thereby to estimate the amount that remains invested in the firm at any given point of time. The various components of working capital can broadly be classified as current assets. Current assets includes cash and bank balances, inventories. Within inventories, we have inventory of raw material, inventory of work in process, inventory of finished goods, and then third, receivables. While current liabilities will have creditors for purchases and creditors for expenses. Different components of current assets require funds depending upon the respective operating cycle and costs involved. The current liabilities provide financing depending upon the lag in the payment. Analysis of each component of working capital. 1. Cash and bank balances. Every firm must maintain certain level of cash and bank balance. This cash is required to meet daily needs, general expenses, and sometimes for cash purchases to avail cash discount and meet contingencies. How much should be kept as cash depends upon the management's attitude, which can be conservative or aggressive, level of operations, etc. It can be reasonably estimated. Keeping cash would mean investing in least productive assets. So, excess of cash would not create problem for the firms in meeting its day-to-day needs, but it would adversely affect its profitability. Low cash would mean not losing on profitability, but this can adversely affect the reputation and goodwill of the firm if it is not able to meet its liabilities. Number 2, raw material. Every manufacturing organization must keep adequate levels of raw material to meet the production process. How much units of different raw materials should be kept, which are to be used in production, depends upon the level of consumption, time required to procure the raw material, and price of raw material, etc. A balance should be struck, as neither excessive nor too less raw material will be for the benefit of the firm. Excessive raw material would imply unnecessary funds blocked up, wastage, fear of deterioration, damage, obsolescence, etc. And very little would endanger the continuity of productive process. Number 3, work in process. In any manufacturing firm, the production process is continuous and consists of several stages. At any given point in the organization, there will be some units in the production process, some of which are 10% complete, some are 40% complete, some are 60%, and some are 90% or so. These are neither raw material nor finished goods, and they are called work in process. How much unit shall be in work in process also depends upon the production cycle. It is very difficult to measure each individual unit of work in progress depending upon its level of production. So we can assume that all work in progress units are on an average 50% complete with respect to labor and overhead expenses, but raw material is 100% complete. It is assumed that the raw material is fed into the pipeline of production process immediately, while labor and overhead charges are gradually bestowed upon them. If more detailed information is available on the stage of completion, value of work in progress can be estimated on a more reasonable basis. Number 4, finished goods. A trading or a manufacturing concern cannot sell immediately on procuring or production. The finished goods are to be kept in stores before they are sold. The entire cost of finished goods is blocked in stores and working capital is required for the same. Number 5, receivables. The goods are not always sold on cash. They are also sold on credit. It takes some time to realize this cash from customers depending upon the credit allowed to them. Receivables include debtors and bills of exchange. So if we make a credit sale of 60 lakhs annually and give 1 month credit period, then 1 month sale will be locked up as debtors. That is 60 lakhs divided by 12 is equal to rupees 5 lakhs. However, this figure of rupees 5 lakhs also include the profit which should be deducted from the amount of debtors locked up to arrive at the figure of working capital. So far, if we add each component of working capital, we get the gross working capital. If we deduct the components of current liabilities from this, we will get net working capital. These are minus items. Creditors for purchases. When a firm purchases the raw material from the vendors, it also gets some credit period. So if annual purchases are 36 lakhs and the firm gets 2 months period to make the payment, creditors would be rupees 6 lakhs. That is rupees 36 divided by 12 into 2 is equal to 6 lakhs. It helps the firm in funding some current assets. Number 7, creditors for wages and other expenses. Usually the firm makes the payment to workers and for other expenses after some time. They accumulate as work in progress but have not been paid so far, so that part of work in process automatically gets financed through these creditors. So the time lag in payment of wages and other expenses also provide some working capital to the firm. Now, estimating working capital requirement pro forma. Now, let's look at current assets. Cash is the first item. Inventories are classified into raw material, work in process, finished goods. The total of inventories is on the second column. Receivables again carried to second column, and the total of these three items will give you gross working capital, which we can designate as A. Current liabilities will include creditors for purchases, creditors for wages, and total current liabilities carried to third column. Now, excess of current assets over current liabilities, that is A minus B, will be representing the working capital. So, we can also add safety margin to this, which is again in third column. So, the net working capital will be A minus B plus safety margin. Some important point worth considering for the estimation of working capital. Contingencies or safety margin. Sometimes a firm calculates the working capital requirement but also provides some extra amount for contingencies. For example, if working capital comes out to, let's say, 1 lakh, safety margin of 10% may be provided over and above the working capital. So, the working capital would be 1,10,000. Number 2, depreciation. When total costs are blocked in work in progress and finished goods and debtors, these costs also include some non-cash item expenses like depreciation. Since these are non-cash expenses, no cash is blocked. Therefore, it is not appropriate to include these expenses in calculating the working capital. This is also called working capital on cash basis. Graded illustrations. Illustration 14.1. X Limited is engaged in sales and purchase of washing machine. It expects to attain a turnover of 60,000 next year. Its net working capital is estimated at 15% of the net sales. Find out the estimated working capital. Solution. Expected net sales is equal to 60,000. Net working capital is 50% of net sales. Therefore, estimating working capital is equal to 50% of 60,000, which comes to 9,000. Illustration 14.2. Saurabh Limited expects its cost of goods sold for 2015-16 to be 800 lakhs. The expected operating cycle is 90 days. The company wants to keep a minimum cash balance of 2,50,000. Find out the estimated working capital. Assume a year consists of 360 days. Solution is simple. Cash balance required to be maintained is 2,50,000. Working capital for cost of goods sold is 800 lakhs divided by 360 multiplied by 90, because operating cycle is of 90 days. So this comes to 200 lakhs. So the total working capital will be 2,50,000. Illustration 14.3. The management of Royal Industries has called for a statement showing the working capital to finance a level of activity of 8,80,000 units of output for the year. The cost structure for the company's products for the above mentioned activity level is given below. Cost per unit: raw material 20 rupees, direct labor 5 rupees, overheads including depreciation of rupees 5 per unit is equal to 15. So the total of these three items comes to 40. Out of that, profit is 10 per unit and the selling price is 50 rupees per unit. You are also given additional information. Minimum desired cash balance is 20,000. Raw materials are held in stock on an average for 2 months. Work in progress, assume 50% complete for all expenses will approximate to half a month's production. Finished goods remain in warehouse on an average for 1 month. Suppliers of materials extend a month's credit and debtors are provided 2 months credit. Cash sales are 25% of total sales. There is a time lag in payment of wages of a month and half a month in the case of overheads. From the above facts, you are required to prepare a statement showing working capital requirement. Now let's look at the answer. Statement of total cost. Raw material requirement is 1,80,000 into 20, that is 36 lakhs. Direct labor 1,80,000 into 5, 9 lakhs. Overheads excluding depreciation is 1,80,000 into 10, 18 lakhs, and cash cost of production oblique cash cost of sales is 63 lakhs, which is the total of above 3. Now let's work out the statement of working capital requirement. Number 1, current assets, let's total. Minimum cash balance required is 20,000. Raw material 1/6 of 36 lakhs, which is 6 lakhs. Work in progress, total cost divided by 24 because 15 days is required, and 50% of that is for raw material. So 1,31,250. Finished goods, total cost divided by 12 comes to 5,25,000. Debtors 75% into 63 lakhs into 1/6 because 2 months credit is extended. So it comes to 7,87,500. So total current assets are 20,63,750. Now let's look at current liabilities. Creditors are 36 lakhs into 1/12, 3 lakhs. Outstanding labor, because you are paying monthly wages, it comes to 9 lakhs into 1/12, 75,000. Overheads 18 lakhs divided by 124, we are excluding depreciation. So it comes to 75,000. So total current liabilities are 4,50,000. You deduct it from the total current assets. So the net working capital requirement is 16,13,750. Notes. Number 1, depreciation is a non-cash item. Therefore, it has been excluded from total cost as well as overheads. Number 2, work in progress has been assumed to be 50% complete in respect of materials as well as labor and overhead expenses. Stock of raw material is taken equal to 2 months consumption of raw material. Stock of finished goods is taken equal to 1 month cash production cost. Amount involved in debtors is taken equal to 2 months cash cost of credit sales. Creditors balance are equal to 1 month credit purchases. Outstanding wages are equal to 1 month wage cost, and outstanding overheads are equal to half month overheads. The smooth functioning of the business depends to some extent on the efficient management of working capital, and for proper management of working capital, it is important to estimate the working capital requirement. A firm must estimate in advance the requirement of working capital and is divided into permanent working capital and temporary working capital. Different methods are available for estimation of working capital requirements, which are percentage of net sales, percentage of total assets or fixed assets, and on the basis of operating cycle. The working capital may be calculated as excess of current assets over current liabilities. Different component of current assets require fund depending on the respective operating cycle and the cost involved. The current liabilities provide financing depending upon the lag in the payment.